So this was about the make or buy concept. The next concept which we will discuss is the concept of opportunity cost, right? Now let me tell you here, the opportunity cost is not actually a cost. It is not included in the cost sheet, right? But it is a very, very useful concept for decision making purposes. So when we take decisions, we need to see that what are the other options available, what are the other options I am foregoing because I am choosing one particular option. Now you see this, because you see now I can give you one example of opportunity cost. Say this opportunity cost is, I have a plot of land, right? And I can either cultivate potato on that land, or I can cultivate onion in that land. Now I decided to cultivate potato and not to cultivate the onions. So the profit I would have made by cultivating onions in that land, that I am foregoing. So this expected profit from onion cultivating, which I am foregoing because I opted to cultivate potato in that piece of land, that is my opportunity cost. So opportunity cost is actually the earning which I am foregoing because I have not opted for a particular option, right? So while taking decisions, we need to consider that what are the options I am foregoing, right? And what is the expected earning I am foregoing because I am not opting for it. So that concept is called the opportunity cost, and it is a very useful tool in the decision making process. Now here you see one example is there. Assume that if Max buys a part from Sundar and it can use the facilities previously used to manufacture part 2 to produce part 3 for Arjun company. Now you see, it has an option. So one option is it can buy the part from Sundar, right? And not to produce part 2, but instead of that, it is producing another part, which is part 3, for another company. Say the name of the company is Arjun company. Now in such a case, the expected future operating income is 18,000, right? So what now the Max should do, right? So that is the question. What should the company do? So it has a facility, it is an underutilized facility, and this facility, initially he was trying to understand that whether it can be used for part 2 production, or this part 2 can production can be outsourced. And he got an offer from a company which is Sundar and Company. And Sundar and Company, if it outsources, then that facility will remain vacant, right? Remain idle. Now it is thinking that why to keep it idle? Let's produce another part, which is part 3 for another company, which is Arjun company. And if it does so, then it can make an additional operating income of 18,000. Now what the company should do? So it has three options, right? First is make part 2 and do not make part 3. So this is first option. Second is buy part 2 from outside and do not make part 3. This is that means keep that facility idle. The third option is buy part 2 and use the facilities to produce part 3, right? So these are the options available with a company. What the company should do? Now, what is the expected cost of obtaining 1,50,000 parts? Buy part 2, do not make part 3. So if it buys from outside, we have already seen there is a supplier called Sundar and Company. If it buys from outside, his cost will be rupees 82,500. If it buys part 2 and make part 3, right? So it has 82,500 is the cost, and incremental operating income it is getting 18,000. So his cost will become 64,500 effectively, right? And if it makes part 2, then his cost will be 76,500, which we have already seen, already calculated, right? Now, this opportunity cost is the contribution to the income that is foregone by not using the limited resource in the next alternative use. Now, assume that the annual estimated Part 2 requirement for next year is 1,50,000. So, cost per purchase order. Now, if it purchases, the cost per purchase order is 40 rupees. Cost per unit when each purchase is 1500 unit is 0.55. We have already seen there is an offer from a third party which wants to supply at the rate of 0.55. Cost per unit when each purchase is equal to or greater than 1,50,000 is 0.54, right? So, average investment in inventory is what? It is either 1500 into 0.55 by 2. So, if it procures from outside, it is 412.50 or 1,50,000 into rupees 0.54, that is rupees 40,500. Annual interest rate for investment in government bond is 6%. So, if this money he invests in government bonds, it will also incur 6% interest rate. That also he is foregoing. If he is investing in production and not investing it to, the government bonds, the 6% is the opportunity is losing, right? So, rupees 412.50 into 0.06 is rupees 24.75 and rupees 40,500 into 0.06 is rupees 2430. So, this is the income. So, if it doesn't invest in production, right, in inventory and all, he can keep this money in government bonds, right, and government bonds, so he can earn this money. So, this is an income which he is losing, he will lose if he invests in inventory. So, that we need to consider. So, option A is what? Make 100 purchases of 1500 units, that is 1,50,000 units, right. So, purchase order cost is 100 into rupees 40, that is 40,000, 4,000 rupees 4,000. Purchase cost 1,50,000 into 0.55, that is 82,500. Annual interest income 24.75 rupees. Relevant cost is, if I add this, I am getting rupees 86,524.75. Fine. And option B is make one purchase of 1,50,000 units. So, if we do that, then purchase order cost is 1 into rupees 40, that is rupees 40. Purchase cost is 1,50,000 into 0.54, rupees 81,000. Annual interest income is rupees 2430. And relevant cost, if I make the total, it is 83,470. So, what we can do is, we can understand that this, using this opportunity cost, we can decide that whether a particular decision to make or buy, whether I can do undertake or not. Okay. So, we discussed about make or buy, we discussed about opportunity cost. Now, we will discuss that if there is a product we produce where there is a capacity constraint. What is capacity constraint? Capacity constraint is, see, when we decided, right, when we decide that which product to produce, suppose a company has 3 products, right, product 1, product 2, product 3, right, and I need to decide that which product should get priority in production, right. So, out of these 3, which product I should produce? So, I will calculate on what basis? I will see which company is giving maximum contribution per unit, right. If the product which will give me maximum production contribution per unit, that product I should produce in highest number, right, that will increase my profitability also, right. But if there are constraints, right, there can be several types of constraints. There can be constraint in the market demand, there can be constraint in raw material, there can be constraint in the supply of skilled labor, there can be constraint in machine hours, there can be constraint in space, right? So so usually in practical world, the factors of production are not usually available in abundance, right? So I am producing, I am running a factory, but I may not have supply of raw material as I wish. I may not have unlimited demand for my products. These are also called limiting factors or key factors. So if there is a key factor, if there is a constraint, if there is a limiting factor, then I need to decide the product mix on the basis of the contribution per unit of key factor each product is making. For example, suppose my limiting factor is raw material supply. A particular raw material which is required for the production, it is in short supply, its supply is limited, it is not available in abundance. Fine. So in such a case, I need to see that which product is giving me maximum contribution per unit of limiting factor. So that should get my first priority. So I can rank the products on that basis. Fine. Okay. So now say there are two examples, say product 2 and product 3. So sales prices for product 2 is 2.11, for product 3 it is 14.50. The variable expense for product 2 is 0.41 and for product 3 it is 13.90. So contribution for product 2 is 1.70 and contribution for product 3 is 0.60. And what is the contribution margin ratio? It is for product 2 it is 81% and for product 3 it is 4%. So from this figure it is clear which one should be preferable. It should be preferable the product, we should prefer the product 2, because here you see in product 2 the contribution margin is very high compared to the product 3, right? So if my factors of production it is available in abundance, right? So then I should always go for this, but in practice it doesn't happen. So here I have a constraint. What is the constraint? The constraint is the machine hours, right? The total machine hours availability, it is only 3000 units, not more than that. Okay. So now what I have to do, I have to calculate contribution per unit of key factor, right? So here it is giving another some more information that this product 2 it requires 7 machine hours. It requires 7 machine hours to produce, right, per unit, and product 3 requires 2 machine hours. So when I am adding this information, you see the perspective it's getting changed, right? So what is the contribution? So what is my key factor here or the limiting factor here? My limiting factor is the machine hour. So I have to calculate what? I have to calculate contribution per machine hour. So I will calculate the contribution per machine hour and I will see that which product, the product 2 or product 3, which is giving me more contribution per unit of machine hour. So the product which will give me the higher contribution per unit of machine hour, I should give it more preference rather than the other one. So if I calculate, it will look like this. It will look like this. So for product 2 it is how much? 1.70 divided by 7, because it requires 7 machine hours, and for product 3 it is 0.60 divided by 2. Now you see, now the perspective is getting changed, right? When I am calculating the contribution per unit of machine hour, you see the perspective is getting completely changed. Now this one is rank 1 and this one is rank 2. So I have, which one I should prefer now? Of course, I should prefer the product, this product, that is product 3 over the product 2. So initially when the machine hours were available in abundance, my ranking was what? My ranking was, if I go back, you see, my ranking was what? This was the rank 1 and this was the rank 2. So when there is no key factor, this was my rank 1, this was my rank 2, right? I am adding this key factor here, my ranking got changed. What is my rank now? This is my rank 1 and this is my rank 2. So the entire perspective is getting changed. Okay. So we discussed about special order. If I get a special order, what I will do? If I have to make or buy decisions, what I have to do? How I will consider the opportunity cost and how the limiting, if there is any limiting factor or key factor or any constraint is there, then how I will decide that which product to produce and which product not to produce, right? Or which product to give more importance and which product is to give less importance. So that I need to consider. So now let's have a quick view on this. So when this concepts of marginal costing and the CVP analysis is being used, we segregate the cost into two parts. One is the variable cost, other one is the fixed cost. Some cost may be partly variable, partly fixed. We call it semi-variable cost, right? Now, this variable cost and the fixed cost has, they follow a different cost behavior. Their characteristics is different. What is the difference? The variable cost, the total variable cost varies proportionately with the level of production. If the level of production increases, the total variable cost increases proportionately. If the production level decreases, the total variable cost decreases proportionately. However, the variable cost per unit, that doesn't change, that remains same, right, over a given production level or a given time frame. Okay. On the other hand, the fixed cost, the total fixed cost, it remains same, remains constant over a given production level and over a time frame. But the very fixed cost per unit changes with the change in the production level. If the production level increases, then the fixed cost per unit reduces, and if the production level decreases, then the fixed cost per unit increases. It is a reverse relationship, inverse relationship, right? So if the production level is high, then it is always better to have a higher fixed cost component in the total cost structure, right? Because that is also called sometimes economies of scale. So if your production level is high and if you are sure that if you are sure that you will be able to sell, even if you produce at a higher level, then it is always better to go for a higher fixed cost component. So this is one of the reason. I'm giving you one example for when a new educational institute, college starts, right, functioning. Usually they hire guest faculties. So guest faculties are paid on hourly basis, right? Because the college is not certain that how much student enrollment will happen, right? Whether enough students will come to the college for study or not. So there's an uncertainty. So it is better to keep your cost on the variable side. So what they do, they hire the guest faculty members and pay them on hourly basis, right? If the student is more, classes are more, the payment will be high, and vice versa, right? But when the college becomes established, when the courses started becoming popular, student enrollment are or more or less certain. I can predict that in next admission session, how many admissions I will get if I get that idea and hunch. Then it is always better to go for permanent faculty members with fixed salary, monthly salary, right? In such a case, what happens? The cost per hour, right, it gets reduces. Okay. So this decision is a crucial decision, right? This is a very, very important decision. Now, when we do that, we see that whether this decision, in the decision making process, I need to consider what are my relevant cost and what are the irrelevant cost. So when I am saying this, that relevant cost and irrelevant cost, I am talking about from the decision making point of view. When we prepare the cost sheet, right? Suppose as we discussed in earlier sessions, when we prepare the cost sheet, we don't distinguish between relevant cost and irrelevant cost. We include all types of costs there, right, to calculate the cost of production per unit. Fine. But for decision making purposes, we need to consider that which cost is irrelevant and which cost is relevant. Now, there are few basic thumb rules for that. So, what is the first thumb rule? The first thumb rule is that I will consider a cost relevant if the cost is futuristic, right? That is, it is going to incur in future, right? It is not happened yet, but it is going to incur in future, right? And this cost is influenced by my decision, right? I have taken a decision to produce one additional component, right? I need a new raw material for it. So, if I produce it, then this new raw material will be required. Otherwise, it is not. So, this is linked to my decision of produce new component or not. So, this type of cost, which is going to happen in future and which is influenced by my decision, right, that type of cost is relevant cost. And any cost which is already been incurred and that will not get impacted by my decision, right. So, that type of cost, I will say that it is irrelevant. Right. So, we discuss certain examples here. So, first example, suppose we discussed that what is the relevant cost if I get a special one time order. Sometime it happens, right. Suppose I am manufacturing something and then I got an export order from some foreign country, from Sri Lanka for example. I am manufacturing a auto component and I got a special order for a component from Sri Lanka. But my total cost, including fixed and variable cost, it is say rupees 10 per unit, right. Now, out of this rupees 10, rupees 6 is my variable cost, rupees 4 is the fixed cost. And remember one thing, I am also working now under capacity, right. I am not working at 100% capacity. My capacity is 10,000 units per month, but currently I am producing only 6,000 units per month, maybe because of several reasons. Maybe I may not have demand, right, I may not have orders, right, some reason, but other resources I have. So, I am producing at a 6,000 units per month, right, but I can produce up to 10,000 units. And my total cost is 10 rupees per unit, out of which 6 rupees is my variable cost and 4 rupees is my fixed cost, right. Now, in the meantime, what happened? I got a offer, I got an order, right, from a company from Sri Lanka, which wants to purchase my product, but it is not ready to pay 10 rupees, right. It is ready to pay say 7 rupees per unit. Now, the question is whether I will accept it or not accept it, right. Here the question of relevant cost comes into play, right. Now, in this example, this out of 10 rupees, that is my the fixed cost, the 10 rupees total cost, out of that 6 rupees is my variable cost and 4 rupees is my fixed cost. This 4 rupees I am going to incur anyhow, it is not, this 4 rupees is not getting influenced by my decision to accept or not to accept the offer from Sri Lanka, right? So, this 4 rupees is relevant or irrelevant? Of course, it is irrelevant for decision making, right? This 4 rupees I am going to incur anyhow. Fine. So, what is relevant? But if I accept this offer from Sri Lanka, then this 6 rupees per unit variable cost, that is going to increase. Because as I said, the variable cost per unit remains constant, but the total variable cost, it varies with the level of production, right? So, now I am producing say 6,000 units, and another 2,000 unit order I am got from a Sri Lankan company. So, this 2,000 units, the variable cost is going to go up. So, what is the rule? Rule is, first is it should be futuristic, right? So, this order sorry, this order, it is getting affected by my decision of accepting or not accepting the Sri Lankan. If I accept the Sri Lankan order, my total variable cost will increase. When it will increase? In future. So, it is futuristic. So, it is fulfilling the first condition, that is, it has to be futuristic. Second is it going to be influenced by my decision of accepting or not accepting this order? Yes, it is going to get impacted by my decision of accepting or not accepting. If I accept the offer, then my total variable cost will increase. If I won't accept the offer, the total variable cost will remain as it was earlier. It is not going to increase further. So, second condition is also fulfilled, right? So, this when I will consider this whether to accept this offer or not, what is my relevant cost? The relevant cost is not rupees 10, the relevant cost is rupees 6, right? And what is the price it is offering? The price it is offering is rupees 7. So, I am getting a 1 rupee margin, right? So, should I accept this offer? Of course, we should accept, because my relevant cost is lower than my incremental revenue. So, this is the basic concept. Similar concept we use also in case of make or buy. In make or buy, suppose this same company, the auto component company, it is produces one component as which is priced at say rupees 10. Now, out of this rupees 10, 6 rupees is variable, 4 rupees is fixed, right? It has an option. The option is that he got an outside supplier, right, who is willing to supply the same component, right, who is willing to supply the same component, right, and this component he needs to decide that whether to produce or buy from outside. Now, his total cost is rupees 10, right? His total cost is rupees 10, and his total, the supplier is agreed to supply to him at rupees 5, for example, and his variable cost is rupees 6, fixed cost is rupees 4. Now, this rupees 4 he is going to incur in any ways, right? What if he decides to purchase it from outside, then what he needs, he can avoid is this 6 rupees variable cost. So, what is the rule? If you again remember, the rule is what? It has to be futuristic, right? And it has to be influenced by the decision. If he takes the decision to buy from outside, how much is getting influenced? This rupees 6, not rupees 4, right? So, this rupees 6 is the relevant cost. Now, what is the supply price that is the outside agency is offering? If he offers, now I am taking two cases, right? So, there are two suppliers, suppose one supplier is offering it at rupees 5, the other supplier is offering it at rupees 7. What is his relevant cost? Rupees 6. So, the supplier which is offering to supply at rupees 7, he may not be very profitable, because the inside cost of manufacturing is 6, whereas from outside he is getting at rupees 7, right? So he may not be profitable. But the other supplier who is offering it at rupees 5, he may be profitable. Why? Because if he manufactures it, inside, his relevant cost is rupees 6, whereas the outside agency, he is supplying at rupees 5. So the second supplier may be better than compared to manufacturing it inside. But at the same time, as I said, this is only one part of the decision making. The complete decision making depends on many other, such other factors which may be qualitative in nature, right? Like for example, company may decide that if it helps in capturing the market share, right? If it manufactures inside, whether what will be the control over the quality if it is outsourced, right? Is there any government policy regarding it? Is there any societal need, right? Because particularly in a country like India, employment is a big social issue also. So whether giving more employment to people, it fulfills some kind of social goal of the company, right? What is the competitor's attitude towards this? So all these other, qualitative factors, those also plays a major role in the decision making. This calculation is only complements those factors, and based on this, the company takes a complete decision. The other concept which we discussed is the concept of opportunity cost. What is opportunity cost? Opportunity cost is actually not a cost, but it is actually the cost of opportunity foregone. So if I forego certain opportunity, then I am losing some revenue. So that revenue lost, the income lost because I have not adopted the alternate best option. So that is called the opportunity cost, and that we need to consider while taking a decision. The other decision making category which we discussed, which is called product mix, when there is a constraint, right? Product mix when there is a supply constraint or there is a key factor or limiting factor. What is the key factor or limiting factor? In the previous examples, we assume, the underlying assumption is that all these factors of production, material, labor, overhead, etc., their market demand, right? They are available in abundance. That means whatever I will be able to produce, that I will be able to sell, right? So in such a situation where there is no limiting factor, there is no constraint, right? There I should go for which factor? I should go for the factor which in which the contribution margin is the highest, right? If the contribution margin is highest, and if I produce it in abundance, then I should be able to maximize my profit, right? But in practice, in real world, the situation is different. In real world, there are always some production constraints, some limiting factors, some key factors are there, right? There may be limit in the production, limit in the market demand. There may be limit in the raw material. There may be lack of supply of skilled laborers, right? There may be lack of space. So many things are there. So these things are possible. In such a case, if I take my decision on contribution margin alone, that may not be correct, right? So what I should do is, I should calculate the contribution margin per unit, right? So contribution margin per unit of limiting factor. So if the limiting factor is raw material, I can calculate contribution margin per unit of raw material. If the labor hour is the constraint, I can calculate contribution margin per unit of labor hour. If the machine hour is the constraint, I can calculate contribution margin per unit of machine hour, right? And then I can do the ranking. Say for example, the example which we have discussed just now, there the constraint is the machine hour. So what I can do is I can calculate the contribution margin per unit of machine hour, right? And we have seen in the example that here in the first, when there is no constraint, you see the first product is giving 81%, right, contribution margin, whereas the second product is giving only 4%, right? So ideally I should go for which product? Of course the first product, right, which is giving me huge contribution margin, right? But once I introduce this constraint, the machine hour constraints, you see the picture is completely, it is getting reversed, right? So contribution now, you see the first product, its contribution is lower, and the second product per machine hour, its contribution is higher, right? So in the second, if there is a constraint, then I should focus on more on the second product rather than the first product, right? So these are the few cases where the concept of marginal costing and CVP analysis, etc., we can use. Okay, right. So we are going to the next next case where the managers now uh, usually strategically, right, the companies, what they do, they decide that which customers to give more preference, which segment of market we should give more preference, and which customers we should give less preference, right? So uh, while doing this, the concept of marginal costing and CVP analysis and concept of relevant cost plays a very important role, right? So, we are giving one example. So, there is a furniture shop, right? It supplies furniture to two local retailers, right? Say Ram and Sham, and it has a monthly capacity of 3000 machine hours. So, fixed costs are allocated on the basis of revenues. So, you can see that's revenue from these two suppliers. It is 2 lakh and 1 lakh. Variable cost 70,000 and 60,000. Fixed cost is 1 lakh and 50,000. Total operating cost 1 lakh 70,000 and 1 lakh 10,000. Operating income 30,000. And you see, in case of Sham, it is incurring loss, right? So, it is 10,000 loss, and machine hour required is, in case of Ram it is 2,000, but in case of Sham it is only 1,000. So, here you see this concept of limiting factor is coming into play, right? Limiting factor is coming into play. So, if you see, in case of Ram, my contribution is 2 lakh minus 70,000, that is 1 lakh 30,000. So, 1 lakh 30,000 divided by 2,000. So, it is 65, right? And in case of Sham, it is contribution is 40,000. So, 40,000 by 1,000, it is 40, right? Okay. Now, if you make the total, right, the total revenue is 3 lakh, variable cost is 1 lakh 30,000, fixed cost is 1 lakh 50,000, total operating cost is 2 lakh 80,000, operating income is 20,000, and machine hours required is 2 plus 1, that is 3,000. Now, should Kumaran Furniture drop the Ram's business, assuming that dropping Ram would decrease the total fixed cost by 10%? So, now if it drops by 10%, so 1,50,000 is the total fixed cost, and if it drops by 10%, it will be 1,35,000. So, now in the new situation, the revenue will be how much? 2 lakh, variable cost 70,000, fixed cost 1,35,000. So, total operating cost is 2 lakh 5,000. So, operating income is now getting reduced by 5,000 only, and machine hour required is 3,000. So it is Ram's business is providing contribution margin of 40,000. So 40,000 decrease in contribution margin, 15,000 decrease in fixed costs. So 25,000 decrease in operating income, right? Now suppose this if it drops Ram's business, it can lease the excess capacity to the uh, Jadu Corporation, right, for 70,000. Okay. So in such a case, what will happen? So fixed cost would not decrease. Should Kumaran Furniture lease to Jadu? So this is the question I need to answer, right? So this depends on what? This depends on that whether the excess capacity, what is the incremental revenue it is going to incur. Thank you.